It is grey and humid here in Shanghai. It's been beautiful in Beijing. Why did I come down? It's a wonderful city, that's why. And we got some great guests, including Andy Xie, coming up. In terms of the markets, it was a bit mixed yesterday on the mainland. Lack of catalysts, some would argue. Mark Cranfield was pointing out the relative stability around the currency, really, and whether policymakers have gotten what they wanted in terms of the yuan. Maybe this is exactly what they want leading up to the 100-year anniversary of the Communist Party on July the 1st. Let's check in then on the markets. We also have that inflation data, by the way, out on Wednesday, which will be significant, no doubt. OK, let's stay with the inflation theme, and who better to unpick this for us than independent economist Andy Xie, who joins us on set here in Shanghai. Andy, thank you for coming on. In terms of the inflation question then, we're looking ahead to that data out tomorrow. What is the trajectory in your mind for those factory gate prices? Are we looking at a sustained pickup of above 8%?
Yeah, I think so. I think that you look at the commodity price keeps going up. And I think that inside China, food prices still is on the upward trend. There's a labor shortage in China everywhere. So it's a really overheating situation. And so much monetary stimulus is still in the pipeline. I think inflation is a very serious problem. OK,
and if you're sitting in Zhongnanhai, the view is that a sharp pickup in consumer prices will be a point of concern. Are we seeing that pass through? Do you expect that to be passed through from the factory gate to consumer prices that, to this point, have remained relatively subdued?
We're seeing quite a bit of pass through already. And if you look at the food prices being up and up. You look at gasoline price, obviously the response to oil price. So I think we do see pass through. I think the Chinese government, when looks at a situation like that, they tend to go to psychological management in terms of how to tell the people what's going on. I think that the issue is inflation is here to stay. So you can persuade people to not to worry for the time being, but over time, before the end of the year, the psychology could become a problem.
OK, so there's the psychology, and then there's potentially the tipping point then, where the PBOC has to move away from its reiteration that there will be no sharp turns in policy. What is the data point? What is the number? What is the inflection point that could force that change, a more aggressive tightening?
They don't look at numbers, they really look at social stability. China is facing a situation like Japan did when the Plaza Accord happened. It's basically Chinese trade surplus is surging this year and could reach $1 trillion in a year or two. And the currency is under tremendous appreciation pressure. And if you don't keep the currency down, you have a lot of inflation pressure. So. But the government does not want to appreciate the currency. That's the key thing. Your monetary policy cannot be normal if you're artificially suppressing your exchange rate. So I think that's the issue, is that when you do what Japan did in 1985, let the currency go.
And Andy, I guess then to your point, do you think then the currency should be where? Should it be higher or lower than the current level? Because if you bring in the inflation story, they should actually make it stronger.
Well, the currency should be much higher than where it is now.
Okay.
You look at the trade surplus. China's market share in the world has really gained. The pandemic has weakened China's competitors by a few years. So China's international trade competitiveness position has strengthened tremendously. So the currency has to reflect that, but the government doesn't want to do that. So we have a dilemma.
Okay, and to your point then that you think 3 decades of disinflation is over, are you referring to China, or is that going to be a global problem?
It's a global problem. The key is, the bottom line is China's labor market. The labor shortage is very serious. So obviously, it's not like in the past, the monetary stimulus doesn't have consequences because oversupply of labor will keep inflation down. It's not the case anymore, and blue collar wage in China is surging. It's really increasing at a very fast pace. So inflation and a rising wage rate, then on top we have a rising commodity price. This kind of spiral is here to stay. To break that, China has to really adjust its monetary policy. Its monetary policy is is for deflation era, a fixed exchange rate, very low interest rate, and a quantitative easing, basically, in terms of credit creation. So I think this is where the problem China is facing.
So what's the solution then? I mean, yeah, fixing monetary policy, that's the prescription, but what's the tangible solution?
China has to float the exchange rate and normalize the monetary policy to become a normal economy. So it's not like a oversupply of labor. It's a permanent stimulus situation, quantitative easing forever. It's not that anymore. You have to accept the reality and become a normal economy.
Okay, Andy, I want to kind of step back a little bit and get your views on the macroeconomic picture in China. And in terms of that key pillar of growth, the consumer, which all the data suggests is not back to pre-pandemic levels. What are you seeing there? When do you think consumption is going to be back to those levels? How important is it? What is the time frame?
Well, it's back to this. The economy, the system is not normal. It's you will have an undervalued exchange rate. We have monetary inflation. Then the government channels that money into the property market, creating a massive property bubble. And the government takes 10% of GDP out of this property bubble every year. It's basically the benefit to the government. The cost is not felt by anybody because it's like in the price. Price is going up. It's like everybody is gaining something, right? So that 10% taken away is suppressing consumption because its disposable income is reduced, and also chasing the property bubble has led to rising household debt. Now it's over 100%. It's roughly about 100. I would say 140 to 50% of disposable income. So the debt pressure is really weighing down the consumption. So China is where we are is really coming down to this problem of monetary policy. It's a fixed exchange rate and the credit creation, like a quantitative easing, and to fund the government investment, and taking the inflation pressure away by channeling money into the property market to create this bubble. So property inflation, not much consumer inflation. So we have a suppressed consumption.
Okay, they've got to grab the bull by the horns when it comes to monetary policy. Andy Xie, thank you very much for coming on. Thank you for your insights this morning. Independent economist Andy Xie joining us on set here in Shanghai.